last part, option-like security. So I'm gonna introduce some securities that is like option. This is kind of a light part, so you don't really need to focus on studying this portion. I think the first two parts, actually for three parts, are a lot more important. So I'll just briefly introduce this one and then just move on. So option-like securities, the first one is callable bonds, which we already learned, I believe. So callable bond is the bonds that actually give issuers the right to exercise call option, which is buy back the option. Okay. So the compensation for issuer have the call option, so they can actually exercise when interest rate drops. But the buyer side, buyer actually receives a premium, which is usually increasing the yield to maturity. Usually it includes the some called protection period, which means that they cannot immediately exercise it. So this is the value of the callable option, as we actually already saw in chapter 10, I believe. And the value of trade option is just a way to keep increasing, but value of callable option stops to the call price, because if the call price is higher than they exercise the option, so they never above the callable call price. The next one is convertible securities. Now, convertible securities also we learned that I think chapter 10. It has option to holder rather than the issuer. So convertible securities can be exercised by buyer. Typically, give holder right to exchange for a common stock regardless of market price. So the value of a convertible bond is also close to the stock price, because the conversion value is linear, obviously, because that's the stock price. And the convertible bond value is very close, and it's a little bit higher because you have to pay the price of conversion. That's why the convertible bond value is a little bit higher than, first of all, straight that value, because they usually will not exercise the option until the value of that hit the conversion value, which is the stock value. And if they start to exercise it, it's a converted, then they follow the stock price. So the value of that is a little higher than, first of all, that value, and then above the stock value. It's just because you pay, this is the premium for the conversion, the price for conversion. Warrant. Warrant is very similar to the convertible securities. Now, the issuer give the options to buyer holder to purchase stocks, new share of the stock. That's called the warrant. So warrant is also the option-like security. So if you buy a warrant, then you buy the right to buy new share of the stock. Okay. Collateralized loans. So collateralized loans is the loan with collaterals. And in the United States, if the borrower cannot pay back the debt, for the collateralized loans, they basically just give out the collaterals and that's it. That it means that the total, the maximum debt value will be the collateral value. Actually, once the collateral value is below the value of debt, then you cannot get whole values. You only can get the collateral value. So collateralized loans is same as the give the implicit call option to borrower, which means that the borrower may have option to terminate this loan, because once they don't pay back, then they only pay the value of the collaterals. Borrower turns collateral over and they retains right to reclaim it by payment of loans, right? And borrower will repay L dollars and can sell collateral to lenders, I'm sorry, for L dollars, even if ST is less than L. This is lenders. Okay. So payoff to lenders is the maximum lender is obviously you're not going to pay. So if you're a borrower, you're not going to pay back higher than your loan values, right? So if the collateral value is the same as loan, then you're pay. I mean, not really same. Above the loan, then you basically pay off this loan value. And if the collateral value is below the value of the loan, then for lender side, lender cannot collect the money up to the loan value. They only collect up to the value of the collateral, ST. Okay, so that's like call option, right? This is like call option. So collateralized loan is very similar to the call option because borrower has right to have the exercise this option by just paying off the loans or just give the collaterals. They have options. So anytime corporation borrow money, maximum possible collateral for the loan is total firm's asset, right? Which means that you basically cannot collect money more than the firm's asset. So if you're a lender to the companies, the maximum payoff you can get is basically the asset value of the firm. So it's all same as like the option. If you basically just give the lend the money to the company, then you have the company automatically have option because they can only pay back up to the value of the asset, right? Above the asset, no, they're not going to pay back. There are other kinds of options called Asian options. This is not very typical. So you remember European and American options. European option is the option that can exercise only on the expiration date. American option is the option can be exercised on or before the expiration date. Asian options is option with payoff that depends on the average price, not the terminal price or current price underlying asset during portion of the option life. That's called the Asian options. Currency translated option is the have either asset or exercise spread denominated in foreign currency. So you pay dollars, but option value based on euro. That's currency translated options. Digital options have fixed payoff that depends on the price of underlying asset. So instead of having like the floating such as when suppose you have call option and suppose you have put option, and put option limit your loss, but you basically can maximum amount of money when the price keep rising, right? However, digital option just say that, well, there's a certain contract price that you're going to receive fixed amount of money you're going to receive when certain option exercise condition holds. So there's kinds of pre-contract between holder and the writer. So this is end of the chapter 15, which is option market. So option market again have a four part. We define the option, and we see the call option and put option, payoff and profit, and we see various strategies using the call and put option along with holding assets. And then fourth, just option-like security. And first three parts are much more important than the last part. Most exam questions come from probably the first three parts. Okay, so thank you for watching chapter 15, and see you chapter 16.